welcome to Griffonomics. What if I told you that being a Wall Street professional, someone with a Harvard MBA and a billion-dollar supercomputer, actually makes you statistically worse at finding the next breakout stock than, like, a shift manager at a local motel?
Right. It sounds totally counterintuitive.
It really does. But today, we are taking a deep dive into the legendary investment philosophy of Peter Lynch, specifically dissecting what he calls the amateur edge. We're looking at a stack of sources, including excerpts from his seminal work, One Up on Wall Street, and various audio analyses, to extract the ultimate blueprint for the everyday retail investor.
Yeah, and our mission today is to show you, the listener, exactly why your daily life as a consumer and a worker gives you this profound structural advantage over Wall Street professionals. I mean, we're going to deconstruct the specific criteria you need to find a 10-bagger.
A 10-bagger, meaning a stock that returns 10 times your initial investment.
Exactly. Finding those before the institutions even notice they exist.
Well, I want to tackle that opening claim immediately because, honestly, it sounds completely backwards. We are so conditioned to believe that the people with the advanced degrees and the specialized algorithms, the so-called smart money, are just completely in charge, right? So why do you, the everyday listener, actually have the upper hand against Wall Street billionaires?
So it really comes down to severe structural handicaps that are just built into the very nature of institutional funds. I mean, those massive funds currently control roughly 70% of all shares in major publicly traded companies.
Wow, 70%?
Yeah, it's huge. They manage billions of dollars, but because of that massive size, they operate like nuclear-powered cruise ships trying to maneuver into tiny harbors.
Oh, I see. Meaning they can't just quietly slip into a position without causing massive waves.
That is the exact mechanism of market liquidity, yeah. Look, if you or I want to buy 100 shares of a small, promising company, we just click a button, right? The order is filled instantly at the current price. But if a pension fund wants to take a meaningful position, they might need to buy, like, 5 million shares.
Which is a problem because there just aren't enough sellers at that specific price point.
Exactly. There simply aren't enough sellers. So as their brokers chew through the order book, trying to find enough shares, they inadvertently bid the stock price higher and higher. By the time they finish buying, they've basically driven the price up against themselves and completely ruined the pristine valuation that attracted them in the first place.
So the amateur investor operates a nimble speedboat. You can dart in, buy your shares at a massive discount, and just wait for the cruise ships to show up years later and push the price up for you.
Spot on. And the size handicap is really only half the problem here. Fund managers are absolutely paralyzed by a culture of groupthink and career risk.
Okay, career risk. Break that down for me.
Well, their primary unwritten mandate isn't actually to maximize returns for their clients. It's career preservation. There's this famous kind of cynical phrase on Wall Street: you'll never lose your job losing your clients' money in IBM.
Wait, let me make sure I understand the logic there. If a portfolio manager dumps $1 billion into an established, universally approved giant like IBM, and then the whole sector collapses, dragging the stock down 40%,
Yep.
that manager keeps their job because everyone else on Wall Street owned it too. Like, it's viewed as an unavoidable systemic failure.
That is exactly it. It's safe to fail in a crowd. But imagine that same manager allocates capital into a relatively unknown, highly innovative small cap company, a stock that has all the fundamental makings of a 10-bagger.
Oh.
If that obscure company goes bankrupt, that manager is deemed reckless by their oversight committee and fired immediately.
Wow.
So they are culturally forced to overpay for safe certifications. They're locked out of the greatest growth opportunities entirely by their own bureaucratic red tape.
Which means, thanks to the democratization of SEC filings and financial data, you, the listener, have the exact same information the professionals have at the exact same millisecond.
Yeah.
But you don't have an oversight committee breathing down your neck. You can utilize what Lynch calls observation as analysis.
Right, which is huge.
Yeah. Your everyday experiences at the mall, the grocery store, or the factory floor act as the primary catalyst for finding winners, months or even years before Wall Street analysts notice the quarterly revenue bumps.
Exactly. I mean, you are actually conducting fundamental analysis just by being an everyday consumer who visits stores, tests products, and recognizes what's actually gaining traction in the real world.
But I have to push back on this premise just a bit.
Sure.
Because if amateurs have this massive inherent structural edge, why do statistics constantly show that retail day traders just get totally wiped out? I
Right.
mean, the stereotype is that the dumb money buys at the absolute peak at a FOMO and then panic sells at the bottom.
That's a great point, but we have to draw a massive critical distinction here between speculating and investing. The retail day traders who get wiped out are trying to play Wall Street's game. They're trying to read short-term price action, guess macroeconomic interest rate shifts, trade on momentum. They are literally trying to beat high-frequency trading algorithms at a game of milliseconds.
And a human being is always going to lose a math race against a supercomputer.
Always. Every single time. Lynch isn't advocating for day trading. He's advocating for fundamental long-term investing. Your edge isn't in trading faster. It's in observing consumer behavior on the ground and having the patience to let the fundamental narrative play out over years.
All right, so let's assume you possess this structural agility and observational edge. Before you open a brokerage app, because you saw a long line at a coffee shop, you must pass a brutal psychological gauntlet.
Oh, yeah. The mirror test.
Right. Lynch calls it the mirror test, and you must pass this before looking at a single balance sheet. And barrier number one sounds like a complete non sequitur. It's, do I own a house?
Yeah, it sounds weird, but it speaks directly to the psychology of how human beings allocate capital. Think about the agonizingly thorough diligence people apply to buying real estate.
Oh, it's a massive process.
Right. You spend months attending open houses. You hire structural engineers to inspect the foundation. You do soil tests. You audit the school districts. You check the municipal property taxes. The process commands absolute respect.
The analogy from the sources is just brilliant here. People will literally spend a week reading online reviews and watching video tutorials just to buy a $200 microwave.
Totally.
But those same people will dump $20,000 into a speculative tech stock while waiting in line for coffee, just because they overheard a rumor or saw a trending hashtag on social media.
It's crazy because buying a stock is as frictionless as swiping a thumb on an app. Average investors treat the stock market like a friction-free casino.
Right.
Lynch argues that if you apply the exact same rigorous, painstaking diligence process to buying equities that you apply to purchasing a primary residence, your success rate will fundamentally transform.
That makes total sense. Which brings us to barrier two. Do I need the money? This involves the strict rule of sequence of returns risk. The rule is you must never invest capital in the stock market that you will need in the foreseeable future, which generally means the next 3 to 5 years.
Yeah, this is non-negotiable. If you're saving for a child's college tuition that's due in 2 years, or a house down payment you plan to use next spring, that money does not belong in equities.
Because the market is violently unpredictable in the short term.
Exactly. If a sudden macroeconomic crash coincides exactly with the time you need to pay that tuition bill, you'll be forced to liquidate your shares at bargain basement prices.
You essentially turn a temporary paper loss into a permanent destruction of capital, all because your timeline forced your hand.
Precisely. You only deploy capital you can afford to leave entirely undisturbed.
Okay, let's look at barrier three, personal qualities. You would assume that having a Mensa-level IQ, being an absolute mathematical genius, is the key to beating the market. But Lynch argues extreme intellectual brilliance is actually a massive detriment.
It really is. What's fascinating about extreme intellect in investing is that geniuses often rely on elegant, rigid theoretical models. They build these beautiful spreadsheets that assume the market behaves rationally.
But the market is made of people.
Right. Those models completely fail to account for the messy, emotional behavior of the human beings who actually buy and sell shares. The most essential qualities for an investor aren't mathematical at all. They are patience, self-reliance, intellectual humility, and a profound tolerance for psychological pain.
You literally have to cultivate the discipline to snore through the panic generated by financial media. Like, severe market drops shouldn't be viewed as disasters, but as lucrative clearance sales.
Exactly. Snoring through the crash is a superpower.
Okay, so once you pass that psychological mirror test,
Yeah.
you have to know exactly what kind of corporate animal you're tracking. Treating all stocks as if they behave the exact same way is a guaranteed way to decimate your portfolio.
Yeah.
So, Lynch deconstructs the entire equity universe into 6 specific taxonomic categories, and understanding their biological life cycles is paramount in this deep dive.
Yes, and we should start with the Holy Grail category.
Yes. If we're hunting for that Tenbagger, what is it?
That would be the fast growers. These are small, aggressive enterprises compounding their earnings at 20 to 30% annually. This is the fertile ground for massive returns.
20 to 30% is huge.
It is. But crucially, they are rarely complex speculative technology companies. Historically, the best fast growers operate in the most mundane industries imaginable. Motels, diners, local retail chains. They succeed simply by copy-pasting a highly profitable regional blueprint across the country.
But wait, a regional diner chain can't compound at 30% forever, right? I mean, eventually they run out of towns to build in. What happens to a fast grower when it saturates the market?
That is the biological life cycle in action. When a fast grower runs out of white space to expand, it matures into the second category, a stalwart.
A stalwart.
Yeah. These are the multi-billion-dollar global giants. Think Coca-Cola or Procter & Gamble. They grow much slower, maybe 10 to 12% annually.
Are stalwarts still worth owning if the hypergrowth is gone? I mean, why not just sell?
Oh, they're absolutely worth owning because stalwarts offer incredible recession protection. Demand for their products, things like toothpaste or dog food, is highly inelastic. People buy toothpaste even during a depression.
That's true.
The strategy for stalwarts is dynamic rotation. You buy an undervalued stalwart, wait for it to achieve a 30% gain, sell it, and then rotate that capital into the next undervalued stalwart.
Okay, but what happens if a stalwart's management gets complacent and stops innovating entirely, like they just rest on their laurels?
Then they degrade into the third category, slow growers or sluggards. These are aging dinosaurs, legacy telecoms, massive utility companies. They grow at a sluggish 2 to 4%, which is roughly the pace of the gross national product.
Just barely keeping up with inflation.
Right. People are usually tempted to buy them for their generous dividends, but mathematically, a stock's price tracks its underlying earnings growth over the long run. If you are looking to aggressively compound wealth, these represent a massive opportunity cost.
Got it. Now, there is another category that seems perfectly tailored for the everyday worker's edge. Cyclicals.
Oh, I love cyclicals.
Yeah. Companies in autos, steel, airlines, chemicals. Their sales and profits violently expand and contract in a regular pattern.
But timing is absolutely counterintuitive with cyclicals. A cyclical company looks the cheapest and safest at the absolute peak of an economic boom.
Why is that?
Because earnings are at historic highs, and the valuation metrics look incredibly cheap. But that is actually the most dangerous time to buy because the cycle is out to turn downwards, and earnings will vanish overnight.
See, this is exactly where the factory floor observation beats the Wall Street analyst. If you're a manager at a chemical plant and you observe a sudden surge in canceled orders or a massive buildup of unsold inventory on the floor,
Yep, you see it first.
you have real-time data that the cycle is peaking months before the analysts see the delayed quarterly reports.
Exactly, you beat them to the punch. Now, category 5 is for the sleuths. Asset plays. These are companies sitting on spectacularly valuable hidden assets that the broad Wall Street consensus has completely overlooked, mostly because analysts are obsessively focused on short-term operating earnings.
The ultimate example from the sources is Pebble Beach in the late 70s.
Oh, that's a classic.
It's wild. The market valued the entire company at $25 million based on its golf operations. But just days after it was acquired, a single gravel pit belonging to the company was sold for $30 million.
Just the gravel pit.
Right. The hidden assets were worth far more than the entire stock price. You're essentially buying a great deal of something for nothing.
And finally, we have category 6, turnarounds. These are battered companies in the corporate ICU escaping bankruptcy, or companies curing themselves of terrible management decisions.
Okay, so we know we're primarily hunting for fast growers and asset plays. But what does the perfect target actually look like in the wild? Lynch details a concept we can call the mundane moat. His perfect stock has 13 specific characteristics, and they deliberately fly in the face of conventional Wall Street glamour.
Yeah, he favors companies that sound dull, or even better, ridiculous. A name like Pet Boys or Bob Evans Farms keeps Wall Street analysts away because they prefer pitching sophisticated, futuristic-sounding tech names to their clients.
He also loves companies that do something completely disagreeable, things that make people shrug, retch, or turn away in disgust.
Yes.
Cleaning greasy auto parts, manufacturing hot dog casings, or handling toxic waste, or even companies operating in a depressing industry, like a funeral home chain. But why is revulsion an advantage?
Because thrilling, high-growth industries attract fierce competition from thousands of brilliant minds. If you start a buzzy artificial intelligence company, you are fighting Google and Microsoft tomorrow.
You'll get crushed.
Right. But a dull, disagreeable or depressing no-growth industry faces zero competition. It gives the amateur investor years to purchase the stock at a massive discount before it ever becomes trendy.
He also highlights the power of corporate spin-offs in the source material. Why do spin-offs create such a structural advantage for the investor?
Well, when a massive parent company spins off a smaller division into its own separate public company, institutional investors often blindly sell the new shares because it doesn't fit their specific portfolio mandates.
Oh, so they're literally forced to sell it, regardless of if it's a good company.
Exactly. This creates immense downward pressure on the stock price, completely divorced from the company's actual value. Furthermore, the new management team of the spinoff suddenly has a clean slate, heavy stock-based incentives, and the freedom to innovate without parent company bureaucracy.
Wow. You also want companies with local geographic monopolies, like a rock pit, or companies that don't invent technology, but simply use cheap technology to cut their own operating costs, like a supermarket implementing automatic barcode scanners. And if we look at the ultimate alpha indicators, you want to see a total absence of Wall Street. Zero analyst coverage and institutional ownership under 5%. If the cruise ships aren't there yet, the harbor is yours.
But qualitative observation isn't enough. You have to dive into quantitative forensics. The ultimate formula is evaluating the price-to-earnings ratio, the PE, relative to the growth rate.
Okay, let's break down the PE ratio because it is the most cited metric in finance, but rarely understood. Can you explain the underlying logic of a PE multiple?
Think of it like buying a small local business. Let's say a local bakery generates $10,000 a year in pure profit.
Okay.
If the owner wants to sell that bakery to you for $100,000, you are paying a multiple of 10 times its current earnings. That is a PE of 10. It would take you 10 years of those profits to earn back your purchase price, assuming zero growth.
That makes perfect sense. So applied to a stock, if a fast grower is expanding its earnings at 25% a year, what kind of PE am I looking for?
The golden rule is that the PE ratio must equal or be less than the company's growth rate. If it's growing at 25%, a PE of 20 is fantastic. You are buying that growth at a discount.
But if I pay a PE of 50 for that same company?
It is a disaster waiting to happen. The expectations baked into the price are so high that any slight stumble will cause the stock to collapse.
We also have to note the difference in insider trading. Executives selling their shares is often blasted across the news, but Lynch says to ignore insider selling.
Yeah, completely ignore it.
Right, because executives sell shares for a million personal reasons, buying a house, paying taxes, or just diversifying their wealth. It's usually just noise. But insider buying.
That is the ultimate fundamental buy signal. There is no better tip-off to a stock's probable success than corporate officers and directors using their own personal after-tax money to buy shares in their own company.
I have to point out the brilliance of a specific phrase Lynch uses to describe the ideal business. He says his perfect stock is one where any idiot could run this joint, which honestly sounds incredibly insulting.
It does, but it's actually the highest compliment for a business model. It means the fundamental operations are so bulletproof, the product is so essential, that the company doesn't require a visionary once-in-a-generation genius to keep it profitable.
The business itself is the asset, not just the CEO.
Exactly. Because sooner or later, any idiot probably is going to be running it.
All right, so you've spotted the ugly duckling, you passed the mirror test, you checked the PE ratio and saw insiders buying. How do you actually manage the position without letting your emotions ruin your returns? This brings us to the 2-minute drill.
Yeah, this is crucial. Before you allocate a single dollar of capital, you must literally stand in your living room and deliver a 2-minute monologue out loud.
Out loud.
Out loud. You must articulate exactly why you're buying the stock, what catalysts will make it succeed, and what the financial structure looks like. If you cannot explain it to a fifth grader in 2 minutes, you have no business buying it.
You also need to know what to actively avoid. The biggest red flag is what the source material calls diworseification.
Oh, diworseification. This happens when highly profitable companies generate massive excess cash. But instead of returning it to shareholders or sticking to their core competency, the CEO wants to build an empire. So they blow the cash on foolish, unrelated acquisitions.
Imagine a highly successful razor blade company taking their billions in profit and deciding to buy a struggling regional airline.
Right, just a terrible idea.
They know nothing about aviation, but they buy it anyway just to grow the total size of the conglomerate. It destroys shareholder value.
Exactly. You also want to avoid whisper stocks. These are the long shots banking on a miracle cure or an unproven mineral strike that have zero actual earnings.
Let's discuss the most critical aspect of managing the portfolio, your sell discipline. It comes down to a concept of pruning versus watering. The deadliest amateur trap is what Lynch calls pulling out the flowers and watering the weeds.
Human psychology makes us want to lock in a win. So amateurs automatically sell their massive winners after a 20% gain just to take a profit. Meanwhile, they stubbornly hold on to their massive losers, hoping the price eventually recovers to what they paid for it so they can break even.
They pull out the blooming flowers and pour water on the dying weeds.
It's the exact opposite of what you should do.
You only sell when the fundamental narrative that prompted you to buy the stock deteriorates. For example, if your fast grower simply runs out of towns to build new stores, or the stalwart's PE ratio expands to an absurd 50, you never sell based on arbitrary price targets or automatic stop orders.
Absolutely. To really demonstrate the absolute power of the 2-minute drill and fundamental discipline, let's look at how an empowered amateur handles a pitch.
Oh, I love this. Let's role play this. I want you to be the Wall Street broker calling me with a hot stock tip, and I'm going to respond using plain English, armed with the amateur edge.
All right, I'm ready. Ring, ring. Hello, this is your broker. We are aggressively recommending you initiate a position in a regional motel chain called Lenta. The momentum is incredible, it's a special situation, and it just made our firm's top-tier buy list. You need to get in today.
Oh, I appreciate the call, but let's break down the basic categories first. What kind of company are we actually looking at here? Is this a mature giant paying a dividend, a company sitting on hidden real estate, or a fast grower expanding its footprint?
It is definitively a fast grower. They are expanding very quickly across the entire region.
Excellent. Let's look at the actual numbers behind quickly. Can you prove to me their earnings are actually growing faster this year than they were last year? What is the current price relative to those earnings like? Are we paying a massive premium? And most importantly, are the executives putting their own salaries into buying the stock right now?
Offhand, I don't have those exact fundamental figures. I would have to check the data desk and get back to you.
And I will pass on the trade until you do.
Boom. That is the ultimate defense mechanism. The disciplined amateur refuses to accept the superficial narrative of a special situation. If the broker cannot answer those basic fundamental questions, or if you cannot answer them yourself in your 2-minute drill, you pass.
Because if you don't deeply understand the specific story of why you bought the stock, you'll be utterly paralyzed and make the wrong emotional decision the moment the price inevitably drops.
Right. But I hear people ask, what if I do the research and I'm still wrong? What if the fast grower stumbles?
Yeah, that's the fear.
This is the most comforting part of the entire philosophy, the 6 out of 10 rule. You do not need to be perfect to build generational wealth. If you utilize the fundamental research in the 2-minute drill, and you are right 6 times out of 10, your massive winners, those 10-baggers, will mathematically obliterate the losses from the 4 investments that didn't work out. You just have to let the flowers bloom.
That's incredibly reassuring. So how do you translate this expansive theory into actionable observation starting tomorrow morning? I want to leave you, the listener, with a unique, provocative thought experiment to actively run in your daily life. Instead of just going to the mall and looking for booming, crowded stores, challenge yourself to look for severe friction.
Friction, I like that. Think of a mandatory service or an entrenched product that you interact with every single day that makes you furiously complain. Something that is universally annoying, bureaucratic, or broken.
Then ask yourself, is there a quiet, newly public company out there engineering a definitive, simple solution to that massive, universal annoyance? Because if they are solving a massive point of friction, they have an enormous, total addressable market.
They absolutely do.
And that ugly, unglamorous solution could be your next 10-bagger. You don't need a Wall Street analyst to find it. You can see the problems and the cures in your own daily life. The structural advantage is yours if you apply the rigor to use it. Risk defined. Portfolio protected.